Hello students, you're welcome to LODS lecture series. I'll be taking you through a quick tour on SA314 Intermediate Accounting 2. This video is for study session 3, Leases Accounting. Do enjoy your learning as we go through this video. Introduction. In line with IAS 17, that is International Accounting Standard 17, lease is an agreement whereby the lessor conveys to the lessee in return for a payment the right to use an asset for an agreed period of time. Moreover, lease is an agreement whereby the lessor conveys to the lessee in return for a payment or series of payments the right to use an asset for an agreed period of time. Outline of study session 3. After you might have studied this session, you should be able to define leasing agreement in accordance with IAS 17. You should be able to discuss substance over form, and you should be able to explain different accounting treatment as far as lease is concerned. And lastly, you should be able to account for a finance lease. Definition of leasing agreement in accordance with IAS 17. IAS 17 first issued in September 1982 and it was revised in December 2003. The recent amendment by IFRS 7 issued in August 2005. A lease agreement is an agreement whereby one party, the lessee, pays lease rentals to another party, the lessor, in order to gain the use of an asset for a period of time. The inception of the lease is the earlier of the date of the lease agreement and the date of commitment by the parties to the principal provisions of the lease is classified as either an operating lease or finance lease. In the case of a finance lease, the amounts to be recognized at the commencement of the lease term are determined. The commencement of the lease term is the date from which the lease is entitled to exercise its right to use the leased asset. It is the date of initial recognition of the lease. Types of leases. There are two types of leases, and it includes a finance lease and an operating lease. According to IAS 17, a finance lease is a lease that transfers substantially all the risks and reward incidental to ownership of an asset to the lessee, while an operating lease is any lease other than a finance lease. Example 1. A company has entered into a 4-year lease for a machine with lease rentals of 150,000 naira payable annually in advance and with an optional secondary period of 3 years at rentals of 80%, 60% and 40% of the annual rental in the primary period. It is agreed that these rentals represent a fair commercial rate. The machine has a useful life of 8 years and a cash value of 600,000 naira. Would this lease agreement be a finance lease or an operating lease? If you look at the example in the questions, the lease term period is 4 years and the lease rentals of 150,000 naira is payable annually in advance. And if you look at the machine has a useful life of 8 years and a cash value of 600,000 naira. The contract here is only half of the useful life of the machine, and there is no strong likelihood that the company will exercise the option in 4 years' time because the option is priced at fair value, not at a discount. Thus, the risk and reward of ownership have not passed to the lessee, and this lease should be treated as an operating lease. As far as this question is concerned, the lease agreement is an operating lease. Substance over form. The substance of lease assets transactions means that the lessee takes possession and not the ownership of the asset. The substance of lease asset transaction means that the lessee takes possession and not the ownership of the asset. It is universally endorsed that the lessee should finally reflect in the book of accounts. Therefore, lessee should usually ignore the legal form of the asset by reflecting it in the statement of financial position. What are the reasons for substance over form? All assets that generate income and revenue in the profit and loss account or income statement must be reported in the statement of financial position. Then there is commercial intention of acquire the asset right from the inception. Substance over form includes commercial substance and legal form. In many types of transactions, there is a difference between commercial substance and the legal form. Commercial substance reflects the financial reality of the transaction, while the legal form is the legal reality of the transaction. Accounts are generally required to reflect commercial substance rather than the legal form. When an asset is leased under a finance lease, there is a difference between the legal form of that transaction and its commercial substance. What is exactly legal form means? The asset remains legally owned by the party leasing it out, that is the leaser. Then the commercial substance aspect of it is that the party making the lease payments, that is the lessee, has the use of the asset for most or all of its useful life. The lessee has effectively purchased the asset by taking out a loan, that is the finance lease commitment. Accounting for lease. Accounting for a finance lease under the lessee. Fair value of the leased property is recognized as assets and liabilities on the financial statement. Then the present value of minimum lease payment if the amount is lower or not. Then we have operating lease. Fair value of the leased property is recognized as assets and liabilities on the financial statement. Present value of minimum lease payment if this amount is lower. Then operating lease. Lease payments are recognized as an expense and it has to be on a straight line basis over the lease term. Accounting for leases. Finance lease. Net investment in the lease is recognized as receivables. Then operating lease. Lease income is recognized in income statement and the method to be used is on straight line basis over the lease term. Net investment in the lease, that is the gross investment in the lease discounted at the interest rate implicit in the lease. Then the gross investment in the lease is the aggregate of the minimum lease payment receivables and unguaranteed residual value. Methods of calculating finance charge or method of allocating finance charge. In summary, there are three main methods of allocating the finance charge under each period, which include straight line method, sum of digit method, and actuarial method. Under the straight line method, finance charges are distributed evenly over the period of the lease and are written off to profit and loss account accordingly. That is, we have finance charge divided by duration of lease. Then we have the sum of the digits method. The finance charges will be written off to profit and loss account on the basis of the sum of the year digits. For a leased asset with 3-year lifespan, the finance charge will be distributed in each year profit and loss account as follows. You have the year 1 through 3. We have a digit. If you add all the digits together, we have the 6. We have the total of 6. So 3 divided by the total, which is 6. 3 divided by 6 is 1 over 2. Then 2 divided by 6 is 1 over 3. And 1 divided by 6 is 1 over 6. This 3 over 6 has to be multiply the total charges that we have in order to arrive at the finance charge. Actuarial method. The actuarial method allocates interest to each period at a constant rate on the outstanding amount using the interest rate implicit in the lease. We have come to the end of this study session. Hope to see you next class. Thank you for listening. Bye.